in Chapter 1 is to define and use the accounting equation. The accounting equation is the equation that keeps the accounting information in balance. The assets, which are economic resources the business uses, is equal to liabilities and owner's equity. Liabilities and owner's equity are claims to the economic resources. So the assets always must be equal to the liabilities and owner's equity. Assets, what are they? These are economic resources that have a future benefit to the company. For example, cash. Everybody knows what cash is. Accounts receivable. This is credit we've extended to our customers. Merchandise inventory is what we sell to our customers. We buy from a supplier, we sell the inventory to the customers. Furniture, land, computers, delivery vehicles, buildings, equipment, they are all examples of assets. The claims to the assets include, number one, liabilities. These are debts payable to outsiders of the organization. If you've got a mortgage on your business, that would be a bank loan. That's an obligation or a liability we owe to an outsider. Accounts payable are loans that suppliers have made to us. For example, if you're buying inventory for resale, the supplier extends you the credit, you pay them back, say within 30 days. That's an account payable. The other claim to the asset in the accounting equation is the owner's equity. It's what the owner's claims to the business are after the liabilities. Okay, so it represents the owner's investment in the business over time. The accounting equation, we have assets are always being equal to liabilities and owner's equity. Okay, so what affects the owner's equity? Owner's equity is also known as capital. Capital contains the initial investment by the owner. Additions include net income, which is simply stated revenues minus expenses. That's what net income is. Also, in addition to investments and net income, we might have a net loss. So that could be subtracted from the capital. Another item that's usually subtracted from the capital account of the owner is withdrawals. Owners do not get salaries, they get withdrawals from the business. A withdrawal is a reduction in the investment of the business. Okay, so we said that net income is revenues minus expenses. Now, what are revenues? Revenues are earnings by the business by providing goods to customers or services. Okay, if we provide a service to a business, we would say that is service revenue. Let me get out of there. That would be service revenue. Okay, if we sell a product, that's known as sales revenue. Okay, monies we have on deposit in the bank, we earn interest revenue. And lastly, if we have stock in other corporations, we earn dividend revenue from the earnings of an outside party. So revenues could be sales, service, interest, or dividends. Expenses. these are the outflow of assets or an increase in liabilities in the course of providing goods or services to customers. Common expenses might be salary, rent, utilities, interest, property taxes, telephone, cable, what else? Delivery expenses. These are all examples of expenses that a business may incur. So using the accounting equation and looking at exercise 1-16 in your textbook, okay, I think we're going to be a little bit out of range here. Let me just adjust this. Okay. So, if the liabilities for the first company, Nice Cuts, is $25,000 and the owner's equity is $43,000, what must the assets be? Well, if assets are equal to liabilities and owner's equity, then we would say that the assets for Nice Cuts would be equal to $68,000. Okay, and that's not working for some reason. Now, for the second company, Love Dry Cleaners, if the assets are equal to $85,000 and we don't know what the liabilities are, the owner's equity, they tell us, is $54,000. If we take the 85 less the 54, then the liability should equal $31,000. Excuse me. Hudson gift cards. Assets are $102,000 and the liabilities are $49,000. So we should come up with the owner's equity. Let me just slide this over. Oh no, I don't want to do that. Okay. We want to come up with the owner's equity for Hudson Card and Gift. Okay. Let's advance this. So Nice Cuts, we said $68,000. Love Dry, we said $31,000, and Hudson Card and Gift would be $53,000. So that's how you use the accounting equation to solve problems like that. Okay. So